Welcome to the deep dive. Today we're digging into something huge, the massive generational wealth transfer that's happening right now. We're focusing specifically on the really high-value property in prime central London. Knightsbridge, Belgravia, Mayfair.
That's right. We're talking top-tier assets.
And here's what jumped out from the sources, something a bit surprising perhaps. For these ultra-high net worth families, property isn't seen just as an asset. It's treated more like a family legacy.
Absolutely. It's got that deeper significance.
And the key to making sure that legacy passes smoothly. Well, it isn't just about clever tax planning anymore. It seems it's really about strategic financing.
Exactly. That's what we're diving into today. How high net worth families, particularly in 2025, are using quite flexible lending structures. The goal is to create what you might call succession-friendly ownership, especially for these key properties, the ones valued at, say, 10 million or more.
Okay, so setting the scene a bit.
Yeah.
There are literally trillions changing hands globally this decade, right? From creators to heirs.
That's the backdrop. And it's driving this fundamental shift in what borrowers at this level prioritize. They're not just chasing the absolute lowest interest rate margins anymore.
Right, that used to be the main game, didn't it? Squeezing every last basis point.
It was. But the focus now, the new gold standard, is flexibility.
Flexibility. What does that actually mean in this context?
It means the ability to refinance, maybe restructure, or crucially, transition ownership to the next generation without causing a huge liquidity squeeze or, worse, a forced sale.
Okay, hold on. So you're saying financing adding debt actually helps with a smooth transfer. That feels, well, a bit counterintuitive.
It does seem backward at first glance, I agree.
Isn't it just passing on a big liability for the kids to deal with?
That's the old way of thinking, perhaps. What we're seeing is a crucial shift. Private banks and specialist lenders are now offering really bespoke facilities. These aren't standard mortgages. They're designed specifically to work with existing family office setups or trust arrangements. They anticipate the succession event.
So the loan becomes a tool, not just a debt.
Precisely. It turns that potential liability into a strategic tool for continuity and control.
Okay, I'm starting to see it. What do these bespoke structures actually look like in practice? Any specific strategies?
Yeah, a couple stand out. First, there's joint refinancing. This is where the first generation owner, maybe the parents, refinances the property together with their adult children.
Ah, so they become co-borrowers from the start.
Exactly. It allows for a gradual, managed transfer of equity through that shared ownership. Makes the whole process much more seamless, less of a sudden shock when inheritance eventually happens.
And the sources mentioned successor clauses. What are those about?
Those are really critical, sometimes called legacy clauses. They're written directly into the loan agreement itself.
Okay.
And what they do is ensure the loan facility remains intact even when control of the asset passes to the heirs.
So the biggest risk they remove is?
It's avoiding the need for a full repayment or, crucially, having to completely re-underwrite the entire loan just because the ownership changed. That can be a massive headache. And there's always a risk the new owners might not qualify under stricter terms.
Right, like that example in the sources, the 25 million place in Belgravia.
Yes, that illustrated it well. The loan was structured under a UK limited company.
And they just added the heirs onto the company.
As co-borrowers, yes, and as directors. So control passed smoothly within the company structure, the loan stayed in place, and importantly, it maintained liquidity within that structure.
Okay, but inheriting something worth 25 million pounds, surely liquidity isn't the main problem.
But that's the key challenge successors often face. They inherit these incredibly valuable assets, but they're often highly illiquid.
Meaning they can't easily turn the property into cash.
Exactly. And they might need cash now.
Why now? If they've just inherited this huge asset.
Well, think about immediate costs. There could be capital gains tax liabilities, maybe significant inheritance tax due quite quickly, or sometimes complex situations like needing funds to buy out other beneficiaries within a trust.
Right. The asset itself doesn't pay those bills.
Precisely. The property is the wealth, but it doesn't solve the immediate cash flow problem.
So how does the financing help there?
This is where those flexible mortgage features become vital. Things like drawdown facilities or revolving credit facilities, RCFs.
Okay, an RCF. How's that different from a standard loan?
Unlike a typical mortgage where you get a lump sum and just pay it down, an RCF acts more like a large pre-approved line of credit secured against the property's value.
So they can draw down funds as needed.
Exactly. It provides that immediate on-demand cash for taxes or buyouts or even just essential upkeep without forcing them into a quick, potentially damaging sale of the underlying asset.
Okay, so zooming out, The big takeaway seems to be that financing isn't just something you reactively sort out anymore.
Not at this level, no.
It's become a proactive tool for stability, for control across generations.
Absolutely. But, and this is crucial, it only works if there's early coordinated planning.
Mimi.
Meaning you need the lenders, the lawyers, the trustees, the family office, everyone talking to each other well in advance. It has to be integrated.
So, wrapping this up, the most successful generational transfers now seem to treat debt not just as a line item on a balance sheet, but as a strategic foundation.
That's a good way to put it. It's a tool for ensuring the legacy continues as intended.
Which leads to a final thought, maybe something for you listening to consider.
Yes, given how complex these ownership structures often are, international elements, multiple trusts, cross-border issues, how much earlier should families really start having these coordinated lending discussions? If the goal is truly guaranteeing that intended legacy, maybe the planning needs to start years, perhaps even a decade, earlier than many currently think. It's about seeing debt as the key to future control.